My name is Lynette Badenhorst, and I will be doing this presentation today for you on ISA315 and 330. So firstly, I'm the Managing Director of Prabita Training, and secondly, I'm passionate about auditing. So I'm very excited to start this new journey with you in your firm so that you will be able to implement these new ISAs as smoothly and successfully as possible. The new ISA 315 and 330 is one of the biggest changes that we had since 2009 in the auditing field. And I'm sure that for most of you here today, this is your first step towards implementing these new standards in your firm. My job today will be to assist you in this process every step of the way. So today I'm going to show you what the new standards are all about. It's a summarized version of the standards. But let's start with our agenda for today. Firstly, I'm just going to talk about the effective date. When should you apply the standard for the first time? I'm going to look at scalability. What does the standard say about small audit engagements? We always had an issue with that. What is a small engagement? What is a large engagement? What can you leave out for a small engagement? So I'm just going to answer all those questions. The major changes that you need to take note of. I'm going to provide you with a quick overview of these major changes. Remember, it's just a summary of what you can expect and what you need to know going forward. Then I'm going to explain to you the meaning of the word acceptably low level. You need to understand this concept for the standards to make sense. This is the part that's going to make you feel uncomfortable as an auditor. Then there are new assertions, or rather a combination of assertions that we need to get used to. I'm going to show you a summary of the responses in terms of the new ISA 330. So there's different responses for different risk assessment and classes of transaction and account balances. And then lastly, what can I do to assist you? Yeah, I will just share some of my suggestions about a possible implementation strategy for your firm. We're all in the same boat. Everybody will have to go back and implement these new standards. So I've worked out a plan for everybody in your organization from your first years right up to the partners that I'm going to do next year so that we can all get the hang of this as quickly as possible, get up and running as quickly as possible, and then also incorporate your methodologies as quickly as possible. Unfortunately, everybody needs to go through training again. It's super important that you do understand the standards before you even look at the methodologies. So let's move on to the effective date. So this standard, ISA 315 and the new ISA 330 is then effective for audits of financial statements for periods beginning on or after December 15, 2021. So that means that the first time that you need to apply these standards is for your December 2022 year ends. Now, you may not use a little bit of the old standard and a little bit of the new standard. If you start an interim audit now, or you're busy with an interim audit for a December 2022 year end or a February 2022 year, you already have to apply this new standard in its totality. You can't combine some of the old principles with some of the new principles. My advice to everybody here today, please forget about the old standards. Throw them in the dustbin. I've done the exercise. When I started my research with this new standards, I tried to match the old requirements with the new requirements. And I thought that I could just use whatever I had and slot the new standards into my old documentation. And I promise you, it's not possible. Don't even try to do it. So for now and going forward, I want everybody to forget about the old standard, forget about what you know about auditing, forget about what you know about risk assessments. We all have to start with a clean slate, start from scratch. So just remember, don't even try to match the old requirements with the new ones. It's impossible. The whole standard has changed. Some of the principles they retained, but there's a whole lot of new things that you need to know about. So I'm just going to show you all of the new things. And I think at the end of the day, you will agree with me that you can't match the two. You have to start all over again. If you talk about scalability, we always had that question about small engagement, large engagements. What can you do less in a smaller engagement? Now, if you look at the new ISA315, it is clear that it's intended for the audits of all entity, regardless of the size or the complexity. So what is the meaning of scalability then? So what they talk about in the new standard is they refer to less complex entities rather than smaller entities. So we do not have such a thing anymore as a smaller audit or a large audit engagement. They talk about a less complex or a more complex entity. But the requirements of ISA 315 are applicable to all entities, regardless of their size. So whether you've got a less complex entity or a large audit or a more complex entity, you have to apply all the requirements. You cannot leave anything out. So when they talk about scalability in the new standard, they will give you examples of what you can do when you are doing an audit of a less complex entity. And it all comes down to you just need to document a little bit less because there is less to document. So it's going to be less procedures, less documentation, because it's a smaller entity. But the requirements are exactly the same. So what you do on a large entity or a more complex entity is exactly what you're going to do on a less complex entity. Moral of the story is you cannot leave any requirement out. You have to address them all. Again, my advice to you, please forget about the concept of a small audit engagement. There is no such a thing anymore. Please do not refer to that thing in any of your working papers. We're going to refer to it as less complex entities. But for all practical reasons, the number of requirements stays exactly the same. So what is this new risk assessment process then? So the aim for the auditor is to achieve a more robust risk identification and assessment process, thereby promoting a more effective response to the identified risks. Ladies and gentlemen, if you look at your new methodologies, and I've seen some of these methodologies, if you do not do proper risk assessments going forward, you will end up with a blank audit program. So your trainee will arrive there at the client and they will have absolutely no audit procedures in that audit program. So the methodologies are designed in such a way that it will respond to the risk assessments. So just to take one step back, in the past, it was possible, and I'm not saying that it was allowed, I'm just saying that it was possible that you could send some of your trainees to start with the audit engagement to perform some of audit procedures and later on just go back to the office and complete some of the planning documentations. Going forward, that will not be possible anymore. So the new standards will force you to do a proper risk assessment, and then based on that risk assessment, it's going to design the audit procedures for you. So you will only have audit procedures that respond directly to the risks that you've identified. So if you didn't do a risk assessment, there will be no audit programs or audit steps to follow. Some of the major changes to take note of is a new risk assessment procedures. We call it RAP. So you're going to RAP in your firm. You're going to RAP. I'm going to tell you how to RAP. and then increased focus on the entity's financial reporting requirements. I'll tell you more about this a little bit later on. Then we also got some new assertions, or rather a combination of assertions. You still got your assertions for transactions, and you got your assertions for balances. I just want to show you the changes that I made. So we still have our pots, as I refer to them. So what we're going to do is we're going to take our transactions and we're going to put them in a pot. Let's say this is our revenue pot, or your cost of sales, or any transaction pot. We're going to throw all our transactions in our pot, and then we're going to apply our assertions for transactions. Now there we've got the 5 assertions like before, which is occurrence, accuracy, classification, cut-off, and completeness. So no changes here really on the transaction parts. But if we have a look at the balance sheet parts, we're going to take all the balance sheet items. We're going to throw all the balances in a pot. And then we're going to apply the assertions for the balance sheet items, which is existence, rights and obligations, classification. So this is a new one that I brought into the balances parts. And then they've changed this to accuracy, valuation, and allocation. So usually it was valuation or allocation. So we had allocation there and valuation on its own. But now they've changed it and they call it accuracy, valuation, and allocation. So I'm going to refer to this as AVA today. And then we still got completeness. Then we've got presentation. So it's not gone. There's still an assertion for presentation. So whether you test the transaction parts or the balance sheet parts, you will always test it for presentation. I'm just going to treat this one as a separate assertion. And if I show you my 10-point plan later on, you will see that this is always there, but that is step 10. So we're first going to audit all the assertions, or the relevant assertions, as I call them now in the new standards. And then once we're done with all of these assertions, we're going to look at presentation. So the same applies for the transaction parts and the balance sheet parts. Then they've introduced the new concept of inherent risk factors. Now, like the assertions, they've also got 5 inherent risk factors. Let's go through them and then I'll explain them to you in a more practical way. So the first one is complexity. Subjectivity is the second one. Uncertainty, the third one. The fourth one is change. And then we've got number 5, which is the susceptibility to misstatement due to management bias or other fraud risk factors. So what are they talking about here? So first what we're going to do is we're going to take our pots. So here is a pot. Doesn't matter if it's a transaction pot or a balance sheet pot. Remember, we're going to throw all our transactions in a pot or our balances in a pot. We're going to cut the pot where our performance materiality is. Let's say for today it is 70,000 Rand. Some items will be above the line, some items will be below the line. If I talk about above the line, I'm talking about material items above the line, immaterial items below the line. So this is our starting point. It's a pot with either transactions or balances in the pot. Then we know now that every pot has got 5 assertions. 1, 2, 3, 4, 5. What they do now is they bring in the concept of an inherent risk factor. Now, if you look at the new way that you're going to do the risk assessments, it is now a 2-step approach. So please take this down. The first step is to identify a risk over a pot. So you're first going to identify the risk. To help you to identify a risk, you're going to use the risk factors. So this is why they brought this in. They said use the 5 risk factors to help you to identify risks over this pot. And then later on, you're going to see that step number 2 will be to assess this identified risk. And there you're going to use something that we call likelihood and magnitude, just to show you how they've split this out. So a 2-step process going forward. First, you're going to identify the risk. Using your inherent risk factors, you must use it in your files. I'll show you how. And then you're going to assess the identified risk by making use of likelihood and magnitude. So what we're going to do is we're going to list these inherent risk factors. We're going to put 4 on the left-hand side. So here I'm going to list complexity. I'm going to say subjectivity. I'm going to say uncertainty. I'm going to list all of them and change. And number 5, I'm going to put on the right-hand side and I'm going to say management bias and fraud. Now, the reason why I do this is if you read the standards, it says that this pot can only be misstated due to 2 things. The first thing is a big error, a material error. So somebody made a big mistake somewhere in this pot. So it's materially misstated due to an error. And the other reason why a pot could be misstated is due to fraud. Now, when I talk about this fraud, I'm talking about management fraud. Now, remember, who makes these representations? It is management. So what goes into the pot is the responsibility of management. You are on this side. You are skeptical. You are going to put these assertions and what they put in the pot to the test. You want to confirm all of these items in the pot with evidence. But first you need to assess the risk of this pot, this risk of material misstatement. So the first step is to identify the risks. And you're going to use your inherent risk factors. Now, the way that we're going to do it is you're going to ask yourself the 5 questions for every single pot. The first question is there anything in this pot that is complex? Yes or no. So this is simply a yes or a no. Is anything complex? Now, let's say, for example, this is our bank charges pot. I'm just going to use a few pots as an example, just to give you an idea of how we're going to do this. Now, if you look at bank charges, we're going to say, is it complex? And we look at how do they process bank charges? And we say, it's just a normal processing through the cash book. So it's not complex. There's nothing complex about bank charges. Is it subjective? The answer is no. We know that bank charges are not subjective. Is it uncertain? No, there's nothing uncertain about bank charges. Were there any changes from the prior year? Now, ladies and gentlemen, this one is going to be a big one. You need to cast your net very wide here when you think about change. It could be anything. It could be change in the client's systems. It could be a change in the employees who are responsible for the processing of the accounting records. It could be a change in standards. It could be a change in policy. It could be a change in the way they do business. You really, really need to cast that net very wide and think about anything that could have changed from the prior year. And if it could be a yes or a no. So in my example, I've got 4 no's. What does this tell me? It says that there is no risk of errors. So the 4 on the left-hand side will give me an indication if I've got a risk of error in this spot. So no risk of error at this stage. Then I'm going to go to the right-hand side and I'm going to say, will management be biased towards this spot? So if there's an incentive for management to cheat, will they actually use this bank statement pot to cheat? And the answer is no. Nobody will cheat with bank charges because the items are small. There's not a lot of transactions in the pot. So why would they use bank charges? They will rather go for a pot like revenue to cheat, but definitely not bank charges. And then other fraud risk factors is, can the employee steal the bank charges? No, can't steal the bank charges. Can't commit fraud really on bank charges. So my answer here will also be a no. So I've got a no, 4 no's on the left-hand side. So what I'm saying is that I don't have any risk of error in this part. And I also don't have a risk of fraud. So if I indicate my risk per assertions, remember we do it per assertion. So we're going to just say no relevant assertion here, no relevant assertion. I'll explain this to you now in a minute. But what it means is that I don't have a risk on any of these assertions. Let's take another part. Let's say I'm going to do 3 parts as an example today. Let's say I've got an inventory part. And my biggest problem that I've got with inventory is that it's a very, very complex transaction. So what I'm going to do is I'm going to list my 4 assertions on this side: complexity, subjectivity, uncertainty, and change. And on the right-hand side, I'm going to say management bias and fraud. And the one that I want to indicate as a risk is complexity. So I've got a yes, let's say no, no, and no, and management bias and fraud, no. Remember, this is just examples. So what do I have? I've got a risk of material misstatement here due to a complex transaction. So I've got a risk of error. Do I have a risk of fraud? No. So I've got a risk of error, yes, no risk of fraud. And then if I have to link it to my assertion, remember it's per pot, per assertion. We never assess the risk only for a pot. We have to assess the risk per pot, per assertion. Now, if this is a balance sheet pot, I've got existence here, rights and obligations, classification, AVA, and completeness. And let's say completeness will have a direct effect on AVA. So I link that risk of error to my assertion, which is AVA. So I don't have a risk here, but I do have a risk of error on AVA, and I don't have a risk on completeness. So using your inherent risk factors will help you to identify whether or not it is a risk of error or fraud. Now you're going to say to me, Lynette, but why is this important? Does it really matter? And the answer is yes, because later on when we assess these risks, you're going to assess a risk of error differently than a risk of fraud. But let's just do one more as an example. I just want to clear my screen quickly. We're going to do one more, and this is our very famous part, which is revenue. So let's say I'm going to apply my risk factors now for revenue. We start with complexity again. You see, we just do the same thing again and again. Uncertainty and change. And on this side, I'm going to say management bias and fraud. And let's say the risk that I identify is because of management bias. Because if management want to cheat, they will use revenue to cheat. We also know that revenue is a presumed fraud risk pot. So you're always going to do this on revenue. So I'm just going to say, yeah, is there a risk of error? Is there a risk of fraud? Yeah, I'm going to document in my files, no, 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 no. And I'm going to say yes on this side. Now I'm going to say, right, management could use revenue to cheat. Let's say their bonuses are based on profit. So there's always the possibility that they will overstate revenue. So the 2 assertions that could be affected by this is they can either put some fictitious transactions in this pot. So that will be occurrence as my relevant assertion. So this one will have a risk on it. We can just list them all. It is occurrence, it's accuracy, it's classification, it's cutoff, and it's completeness. And the other one that they can use to cheat is to play around with dates. So they can overstate the revenue part just by playing around with the dates on the invoices. So I have another assertion here with a risk over that assertion. So that one has got a risk. That one has got no risk, no risk. Yes, there's a risk, no risk. But I've got a risk of fraud. So what do you need to do with these inherent risk factors? You're going to take every single pot on your financial statements. Now, I want you to imagine you take your balance sheet and you take your income statement and you put all the pots next to each other. For all 5 pots, you're going to list 5 assertions. Then for all the pots, you're going to list your 5 inherent risk factors, and you're going to go through this process. And you're going to identify risks of error or risk of frauds on specific assertions. Okay, so that is why you're going to use and how you're going to use the inherent risk factors. Ladies and gentlemen, these risk factors must be documented in your files. Apply it like I showed you, and this you must be able to indicate what inherent risk factor contributed to that risk of error and that risk of fraud. Then they also brought in a new concept of a relevant assertion. So this is something that you need to understand. What is a relevant assertion? A relevant assertion is an assertion with a risk over that assertion. So let's take my 3 pots, my bank charges pot. We said 1, 2, 3, 4, 5. Nothing. There was no risk. So none of these assertions had a risk over them. So they are all not relevant. So I've got no relevant assertions on bank charges. If we look at my inventory pot, I had 1, 2, 3, 4, 5. I had a risk of error over AVA. So that one is not relevant, but that one is relevant. And if I look at my revenue pot, 1, 2, 3, 4, 5, I had 2 relevant. I had occurrence, not relevant, not relevant. Cut off was relevant. Completeness was not relevant. So the meaning of a relevant assertion is if there is an identified risk. We just need to get our wording right. An identified risk over an assertion, then you've got a relevant assertion. And it's these relevant assertions that's going to be the basis for our further audit procedures. Now, just to give you a heads up what's going to happen. If you've got a pot like this, our bank charges pot with no relevant assertions, and you can come to the conclusion and say, but this pot is already on an acceptably low level. There's no relevant assertions. Then you don't have to audit this pot anymore. So you don't have to do anything on this pot. But there are some rules. There are 5 questions that you're going to answer. And if you can answer negative to all 5, a no, no, no for all 5, then you can put the lid on the pot. You can close the pot and you don't have to do anything further on this pot. So a lot of your line items, you can already conclude on it after you've done your risk assessments. But more about that later on. Then another important change is the word significant classes of transactions, account balances, and disclosures. Ladies and gentlemen, please note, this is new. It is not a significant risk that I'm talking about. So if they use the word significant, they use it now twice in the standards. So the one is talking about a significant pot, and the other one is talking about a significant risk over a pot. Okay, so it's absolutely 2 different things. Now, what is the meaning of a significant pot? When is a pot significant? And it says there, a pot is significant if there is one or more relevant assertions. So let's just explain this in more practical terms. What do we mean by that? Now you will remember, what is a relevant assertion? This is if you got a pot where there's a relevant assertion. So let's think about my bank charges pot, 1, 2, 3, 4, 5. I had no relevant assertions over the bank charges pot. So this pot is not significant. If you think about the inventory pot, I had one relevant assertion, that was AVA. It says there one or more. So my revenue, my inventory pot is significant. And then I've got my revenue pot 1, 2, 3, 4, 5. I had two relevant assertions. It was occurrence and it was cut off. And this is also then significant. Now, ladies and gentlemen, can you see that I have not used the word material at all? So significant has got nothing to do with material. So please remember that. So two things. It's not the same as a significant risk, and it's got nothing to do with materiality. Now, what's going to happen with this is, going forward, you're going to have to take every single line item on the financial statement. So every line item represents a pot with 5 assertions. And you're going to have to put every single pot in different zones. And at the end of the day, if you don't know in what zone that pot is going to go into, you won't be able to design further audit procedures. So the first thing that you must be able to do is to put your pots in different zones. Now here is the start of our zones. So I'm going to start off with the following 4 zones, and then later on we will add to these zones. So at the end of the day, we're basically going to have 6 zones. Right, so the first one could be an insignificant pot. Okay, so that's a pot without a relevant assertion, and it is immaterial. So this is one zone that you have here. Or you can have an insignificant pot, but it is material. Or you can have a significant pot, look at this one, significant, which is immaterial. So you might have an immaterial line item, but you have recorded a risk over it. Or it is significant material. Okay. So let's look at our bank charges. Our bank charges is insignificant and probably also immaterial. So you will put your bank charges pot in this zone. You could have insignificant material. Let me just give you an example of this. Let's say you've got a line item on the income statement, salaries and wages. And there are only a few employees, but they earn major salaries. Let's say it's a professional company, they pay a professional salaries, only a few people, but earns quite big salaries. So if you go through your risk assessment, inherent risk factors, and you say, is it complex? You say no. Is it uncertain? No. Is it subjective? No. Did anything change? And let's say nothing has changed from the prior. Last year they had 5 employees. This year they had 5 employees. Nobody resigned. No new employees. They haven't changed the system. Nothing has changed. And then we go to the right-hand side, number 5, and we say, will management use this pot to commit fraud? And we say, no, not. There are too few employees. Can somebody steal the salaries? Oh, well, it's only 5 employees. There are no cash wages. So let's say no risk of error, no risk of fraud. So I'm going to put my salaries and wages although it is a material line item, I'm going to put it here in this zone. Then I can have significant immaterial. I want you to think about things like, let's say, director's loans. It might have a very small amount at year end, but if you look into the pot, there was a lot of activity. So debits and credits that are posted against each other. So they cleared it with they made payments, they maybe cleared it with dividends against that, or payments from the directors. At the end of the day, an immaterial amount on the balance sheet, but lots of activity going on here. And you want to have a look at this account. It's a high risk account. So immaterial, but it is significant. So I'm going to put here director's loans in this zone. And then here I'm going to put my inventory pot. Let's say my inventory in this case is significant material. And I'm going to put my revenue pot in here, significant material. Ladies and gentlemen, you have to take every single line item on your financial statements. You're going to start with the balance sheet. You're going to go through the risk assessments. You're going to put every pot in a zone. Then you're going to take your income statement items and put them in a zone. If you don't know in what zone a pot is, before you do anything else, you will not be able to continue with the audit engagement. So please just make sure that you do understand what is a significant and an insignificant pot. Then what they've also introduced is the concept of a spectrum of inherent risk. Now, this is not really something that is new. It is a fancy name that they gave for an old concept. Now, I just want to show you what they mean by a spectrum of inherent risk. You will remember that I always showed my risk of material misstatement like this. Oops, apologies for my bad drawing here. Now, a risk of material misstatement can be indicated in different ways. So some methodologies, I know the CaseWare methodology, for example, use low, medium, 1, 2, 3, 4, high, 1 or 2, maximum, etc. If you use Draftworx, for example, it was indicated as 1, 2, 3, 4. You could have your own methodology where you say low or very low, low, low to medium, medium, medium to high, high. It doesn't matter how you define it, as long as you had some kind of risk spectrum in your firm. And then each one of these risks are linked or should be linked to a sample size. And if we look at the basic principle, the lower the risk, the less items you have to test from a pot. So here you could test 10. I'm just putting numbers to it, so don't hold me to it. I'm just putting a few numbers here. Okay, on this side, we can say 20, 40, 60, 80 or whatever. I'm just putting numbers. It's not what your methodologies are saying. But this is the basic principle behind this. So you identify and assess your risk of material misstatement. You put it somewhere here on a ROM. And the lower the ROM, the less items you're going to select from the pot. And the higher the ROM, the more items you have to select. Right, so they just gave this now a very fancy name. They call it a spectrum of inherent risk, something that we always did in the past. But why they want you to use the spectrum of inherent risk now is to assess your risk. Now remember, step 1 was to identify a risk. And there you used your risk factors. Now for the risks that you've identified, only those risks, not the whole pot, not the whole pot. So if you've got no relevant risks here or relevant assertions, your risks over a pot, you don't have to do anything. It's only for those pots where you've got a relevant assertion, you've got identified risk over that assertion, that you're going to assess that risk. And to assess the risk, you are going to make use of the likelihood and magnitude. And this can be different settings. Now, what I'm going to show you now is just how we're going to do this assessment of these risks using likelihood and magnitude. Now, if you look at your pots, you know that there could be a risk of error or it's a risk of fraud. You had to tell me, Lynette, it's a risk of error or it's a risk of fraud. And I said it's important that you distinguish between the two because the assessments are different. Now, for a risk of error, you can have different settings. You can say I've got a low likelihood and a low magnitude. Then your risk assessment will be somewhere on the lower end of the spectrum. Or you can have a low likelihood and a high magnitude. You can see then it will sit here somewhere in the middle. Or you can have a high likelihood and a low magnitude. Then it will also sit here somewhere in the middle. Or you can have a high likelihood and a high magnitude. And your risk going to sit here, we call it on the upper end of the spectrum. You can see that for an error, you've got different settings. If you're going to ask me, Lynette, now how do we know what is the likelihood for this identified risk to cause a material misstatement? Or if it is likely to be materially misstated, what is the magnitude? Magnitude means what is the monetary value. The standard says you're going to use your understanding of your part that you've obtained through your risk assessment procedure. So what do you know about the entity? What do you know about the part? And you're going to use that understanding to assess the likelihood and the magnitude. But if it comes to a risk of fraud, ladies and gentlemen, there's only one setting, and that is a high likelihood plus a high magnitude. And there's a very specific reason for that. The standard says you cannot have a low fraud risk. There's no such a thing. There's no low or medium fraud risk. Fraud risk is either high, it's always high likelihood, high magnitude. So if you did raise the risk of fraud, that is your setting, which means that it will always sit on the upper end. A fraud risk will always sit on the upper end of the spectrum. So where does that lead us to? And that is when we've got a significant risk. And they say that an identified wrong for which the assessment of an inherent risk is close to the upper end of the spectrum is a significant risk. So if you got a high likelihood and a high magnitude for an error or a fraud risk, you've got a significant risk. It also says that there are some parts that you will always treat as a significant risk. And that is a risk of the revenue part, journals, estimates, and related parties. Now, ladies and gentlemen, let me summarize this now for you. Remember, these parts here are the so-called presumed fraud risk parts. They're significant, yes, but they also presumed fraud risks, which means that for these parts, you will always have to perform fraud procedures. The reviewer will ask you for these parts, show me your fraud procedure. And there's very, very specific fraud procedures that you need to perform here. So we're going to have the following. Just insignificant parts, significant parts, a significant risk over a part, and a presumed fraud risk. Now, the reason why you have to distinguish between insignificant and significant parts is also a new concept that they brought in. And they said that when we look at controls, the system of controls, you have to take it now one step back. Now, let me just go back one step also in what we did before. If you take a pot and you need to look at the information system, the system of internal controls. In the past, we said that you only have to look at controls, evaluate controls, and identify and test controls for pots with significant risks over this. And that also was dependent on your methodology, because for years people could not agree whether it's only on significant or more than significant pots or other pots besides significant pots. There was always uncertainty because the standard was not clear. Going forward, if you've got an insignificant pot, remember this is a pot with no relevant assertion, you do not need to obtain any understanding of the information system. So take my balance sheet, my bank charges pot. You don't have to look at the system description. But for any significant pot, you have to obtain an understanding of the information system. Ladies and gentlemen, this is a major change. You actually have to go, and for any significant pot, you have to go and obtain an understanding of that pot. You don't have to do the implementation test. But remember my payroll or my salaries and wages pot. It's a significant pot, therefore you have to understand the system, even though there's no relevant assertion. Sorry, I'm talking nonsense. Apologies for this. For my payroll one, you do not need a system description because it was insignificant. But for any significant part, you need to have a system description, work through it, understand it, and evaluate those controls. It's a major, major, major change. The moment that you've got a relevant assertion, a risk over a pot, you have to go and understand the system. For pots with significant risks, okay, if that risk is a risk of error, high risk of error, high likelihood and high magnitude, and a fraud risk, it's a significant risk, then you must also test the implementation. That means you have to do walkthroughs on it. So just a big difference here. Here, you need to obtain an understanding and evaluate it, but you don't have to do a walkthrough. On these parts, you need to do walkthroughs. And obviously on your presumed fraud risk parts, you also have to do walkthroughs. I'm going to put this zone. Yeah, this is a specific zone on its own. And I call this my danger zone. Because everything that falls in your danger zone, that your pots with the significant risks over them, and your presumed fraud risk pots, they in the danger zone. For them, you have to do walkthrough procedures. For the other pots with assertions over it, but it's not a significant risk. So there's a relevant assertion, there's a risk, but it's not a significant risk. You just have to look at the system descriptions. Major, major change. The standard also talks a lot about IT and what to do if your client makes use of very sophisticated IT systems, and if you want to test the IT system and test controls, etc. I'm not going to go into detail there. I just want to focus your attention on the fact that it says that if you want to make use of analytical and data extraction techniques, you can do so. It does not force you to do it. You may do it, and if you want to do it, if you want to use it, they give you a lot of guidance. Then another major change is the stand back clause. Now, I just want to look at my different zones and where you have to do a stand back. So first is an insignificant part. So there's no relevant assertion and it is immaterial. That's the one zone. So that was my bank charges. Then we had insignificant, no relevant assertion, but it is material. So then we had significant, relevant assertion, immaterial. We've got significant, relevant assertion, material. And we've got significant risks and presumed fraud risk pots. At the end of the day, you as the auditor, before the team can start with the audit procedures, must put all your pots in the different zones. So here I have insignificant, I've got my director's loans. Here I've got payroll. Oof, yeah, I'm sorry. Here I've got payroll. Yo, something to get used to. I've got significant immaterial director's loans. Here I can have inventory. Here I have something with a significant risk over it. And here I've got my revenue pots. Okay. Now, this stand back, partners, I'm talking about you. The standard says for these pots, that is material. So you got a material pot, but you don't have a relevant assertion. In my example today, it is payroll. For these pots, you have to do a stand back. So what the standard says is that you have to take one look at it again. And you need to conclude as the partner on the pot and say, you know what? The person who did the planning did not identify any risks over this pot, but the pot is material. And then you're going to say, okay, do I agree with this or not? Because you might have some insight into this pot, which they do not have. If you're happy, you're just going to say, I'll stand back. I considered it again. I'm happy with the conclusion that there is no risk. Or you will say, okay, I know something that you didn't know. So I want you to go back and I want you to raise that risk. This must be formally documented, preferably by partners. You have to sign off on this. Are you happy that there's no risk over a material pot? So stand back requirements on these pots. Then I just quickly want to explain to you the meaning of acceptably low level. Remember I said that if you answer 5 questions, you can say that the pot is already on an acceptably low level. Then you don't have to do anything on that pot. Now, I just want to show to you what is the meaning of acceptably low level. So let's say you got a pot like this. We're going to cut our pots at performance materiality. That's what we always do. Then we're going to throw all the transaction or all the balances in a pot. So here's, let's say this is my pot. Let's say my bank charges pot. There's my 5 assertions. 1, 2, 3, 4, 5. So the 5 questions are, number 1, we're always just going to follow this process. Error or fraud? Is there a risk of error? No. Is there a risk of fraud? No. Remember, we did not identify any risks here. Is there anything above the line to test? So an individually material item, the answer is no. Then we're going to go below the line. Is there an unusual item? Now remember, below the line, we've got immaterial, which could be unusual, or immaterial, which is not unusual. And we always take out unusual items. We take out material ones, then we take out unusual, and then we look at the remaining population. Is there anything unusual? You look at your pot, based on your understanding, no unusual items. Is the total of the remaining population more than performance materiality? And the answer is no. If you got 5 no's, you're already on an acceptably low level. So just to go through them, no risk of error, no risk of fraud. Nothing above the line, nothing unusual below the line. The total items, not even above materiality. You're already on an acceptably low level. The standard says, put the lid on this pot, close it. You don't have to do anything else on this pot. Okay, so now that you understand acceptably low level, you can see where we are going with things. So to summarize the process, ladies and gentlemen, remember, we're going to work with 6 zones. Before you can start your procedures, you have to put every single pot in a zone. Then we can apply ISA 330. ISA 330 has got different steps for different pots, different zones. Here's my first zone. You now should be more familiar with the terminology. Immaterial, not significant, no relevant assertions. Look at the wording. The auditor need not design and perform further procedures where the risk is already below the acceptably low level. That is my bank charges pot. Any pot where you've got 5 no's. Okay? Then you don't have to do anything. Put the lid on, move on. There's an immaterial pot that is significant with a relevant assertion. Remember, director's loan. It's immaterial, but I want to see, I think there's a risk there. Now, this is the part where it says the auditor shall design and perform further audit procedures whose nature, timing, and extent are based on and are responsive to the assessed risk of material misstatement. So, ladies and gentlemen, let's say you've got your 5 assertions here, 1, 2, 3, 4, 5. And you indicated AVA as that problematic assertion. Paragraph 6 says you only have to test AVA. What are you going to do on the other assertions? Nothing. Are you feeling uncomfortable? I'm sure you do. Then we've got material, not significant, no relevant assertions. Ladies and gentlemen, here's my problem child. This is the one that's going to cause havoc in the industry. What it says, it's let's take my payroll. 1, 2, 3, 4, 5. Remember, my payroll, my salaries and wages was material. Okay? It says, irrespective of the assessed risk of material misstatement, the auditor shall design and perform substantive procedures for each material pot. So I don't have a wrong. I don't have risks identified, but the pot is material. So there's no specific assertion to test. So what now? Because it says that you shall perform substantive procedures. Now, a substantive procedure could either be a detailed audit procedure or it could be analytical, substantive analyticals. Now, the standard does continue and it gives us some guidance and it says, well, if you've got a pot, transactions or balances that looks like this, and it's predictable, why don't you try and do a substantive analytical? So instead of going to have to pick an assertion, do an analytical procedure, and it says that will be enough. So I think we're going to go into a lot of analyticals. We just need to sharpen ourselves with, get more knowledge on doing these analyticals because a lot more pots are going to be tested analytically going forward. But if you can't predict, what then? Then it says, pick an assertion. Now you're going to say, Lynette, but pick an assertion. Which one? The standard says, use your professional judgment. Now, this is where the fun and games are going to start, ladies and gentlemen, because I'm going to see how we're going to sit there and frown and say, okay, so what assertion I'm going to test here now? The standard doesn't give much guidance. It just says, use your professional judgment. Think about the one that if it is likely to be misstated. Compare it with other companies where there could be a misstatement in that specific pot, but you did not identify for your client a risk over that pot. which assertion would you then test? Which is the most relevant one? Which is the most one that's most likely to be misstated in general? And that's the assertion that you're going to test. Fun and games. Are you feeling uncomfortable? I know I do. So this is really the problem child. Then we've got material, significant, relevant assertions. Now this one is also easy. This is a pot. This is like my, let's say, inventory. 1, 2, 3, 4, 5. Material. You identified AVA. AVA. You're going to perform procedures only on AVA. And then for significant risks, well, there you're going to do substantive procedures that are specifically responsive to that risk. So there you're going to still continue with your special audit procedures. Ladies and gentlemen, if I can give you good advice, go and print this document, keep it next to you until you get used to this method, all right, of doing things. So what is the way forward? Just some advice from my side. Update your methodologies, just some feedback there. The methodologies are slowly but surely getting released. So if you buy a methodology, they are busy updating it, they're releasing it as we speak. Most important thing is you need to now implement what I told you now into those methodologies. Where to start? Get rid of the old standard. Like I said earlier, throw them away. If you want to get to grips with this, you need to read the new standards. You need to listen to videos. You need to read implementation guidance. Now, you're going to say to me, Lynette, get real. We've got real jobs, not like you that are spending all your time reading standards and interpreting these things. We've got work to do. Where should we find the time? Good news, ladies and gentlemen, I have already done this for you. I've spent hours and hours trying to figure out what is going on here. And to help you with this, I've put some documents together, and I just quickly want to show you a document that we're going to send to you that just have it at hand in your firms if you want to read something, because this is easier to read than the standards. I just want to make sure you can see my screen. Yes. So this is a document, a comprehensive guide that I'm going to send to everyone, where I've summarized all of the things that you need to know in this document for you. The things in red is what I highlighted. That is what we're talking about, all of the new things. That's the one thing. If you don't get time to read through these things and listen to videos, don't worry. We've got everything sorted on our side. So what I've done is I've worked out a plan to make sure that everybody implements these new standards as quickly as possible, smoothly as possible, without too much headaches in your firms. But it's going to require some time from everyone. I mean, there is no ways that anybody will be able to implement these new standards, learn the standards, learn the methodologies without giving up some time. So what I've done, I've worked out a program for everyone in the firm. So I've got and this is just my suggestions, what will make it the easiest way to implement. I've got a practical implementation session with no methodology, like I'm doing today, but spending a whole day on this new standard. I mean, what I did today was a drop in the ocean. This is suitable for partners and managers, and I would recommend this for partners and managers who want to understand the new standards, who are not necessarily going to work on the methodologies itself. Okay, so you're just going to review files, you want to know what the new standards are all about. If you are working on CaseWare and Draftworx, I've got a practical implementation of these standards, and I say that it's suitable to all staff who worked on CaseWare and Draftworx before. Ladies and gentlemen, here you need a very good knowledge of CaseWare and Draftworx, and you already did planning on these packages before. I can do it in 1 day or 2 days, but I did find that I'm struggling to get through 1 day if you don't have the basic background of the standard. So I would suggest 2 full days here. Then for your trainees, it's going to go into the 2nd year of training. I've got planning the audit based on CaseWare or Draftworx. They've never done planning before, so they're going to go into planning. They need to learn how to do planning. I take them for 2 days. I teach them everything they need to know so that they can go back to your office and they can do proper planning. They will understand the standard and they will understand their methodologies. Finalizing the audit based on CaseWare or Draftworx, it might seem that it's not so important, but there's so many important things in finalizing the audit. This is for senior trainees, 3rd years, that's going to assist with finalizing those files, reviewing files, how to review a file, what to look out for. 2 full days. I cannot do it less than 2 days, ladies and gentlemen. And then our flagship is the Pro and the CaseWare and the Draftworx Junior Audit Simulation for 1st years. Now, ladies and gentlemen, here I need 5 days. And I promise you, I cannot do it in less than 5 days. It is packed. I take your 1st year. I take them through an audit. I explain to them assertions. I explain to them direction of testing. We give them a file full of evidence of a client. And they have to audit, physically go and audit the different line items, PPE, investment property, investment, inventory, debtors, creditors, long-term liabilities. And I show them exactly how to audit. And they put an audit file together and they have to do those working papers. We look at the standard of the working papers. We look at legends, how to describe those legends, how to document things in the files. And they have to submit their working papers every step of the way. And we review those working papers as if we partners. And we send them review notes. And they have to fix those review notes until they are 100% correct. We don't give up on them until they're 100% correct, until we are happy that they know what is going on. So I need 5 days of their time. But I will then send you back a trainee that you can start using immediately because they will have the basic information. They will know what an assertion, they will know how to test every assertion. So we are going to show them how to test every single assertion. They know exactly how to test for occurrence, how to test for existence, how to test for completeness, direction of testing. At the end of the day, you as the partner or the manager is going to plan in terms of the new ISAs are going to tell them which ones to audit. But at least if you tell them to audit AVA, they will know exactly how to audit AVA for PPE, investment, property investment, all of those line items. So you can start using them immediately. I know 5 days sounds long, but I promise you it's not even enough time to take them through everything, but I give them a lot of things to do. So that is our plan. If you want more to know more about it, Narissa will send you all the information about dates and everything. I am also available for in-house training for your firms if you would like that. Virtual, face-to-face, you just let me know. So I can assist with implementation. I'm going to give you a guide. We're going to send you dates for next year. Okay, so what about this course? Where can you get your CPD? It's on Akanani. Narissa will send you everything. So on our Akanani site, let me just give you an idea quickly. What am I talking about here? Here's Akanani. You're just going to go to, apologies for this. Let me just go to Akanani. You go to available lessons. And what you do is you search here by ISA315. And, oh, sorry about that. If you search here, whatever you search for, it will come up here and you can just add it to your cart. This is free. You don't have to pay anything, but we upload. Some of you will know already that we put all our videos, everything in here for you to get your CPD. Then just the very last thing, please go and register for your post-assessment results portal. If you do your post-assessment, you can have access to our post-assessment results portal. It looks like this. It gives you a summary of every single post-assessment that you've done with us and is going to do. And it will give you access to your certificates again. You can have this ready for your CPD. I know everybody is now eager to have their CPD reports finalized for the institutes. It's also nice for trainees because you can ask them at any time to send you this report. They just simply print it, download it, PDF, Excel, whatever format you want it, and they can send it to you. So ladies and gentlemen, that is from my side what I have available for you. I'm sure that you will have a very good idea now what is going to happen going forward, what is required of you. From myself and my team, I want to thank you for attending today.